Okay. Good morning. Good morning. We're just letting everyone come in from the waiting room, so we'll give it a couple of seconds. Okay, I think everyone is here. So, good morning and welcome to today's webinar on Roth IRA conversions. My name is Camille Blomdahl, and I'm the Director of Client Services at WealthTrace. I'm joined by Doug Carey, who is the founder of WealthTrace and a chartered financial analyst.
Hey, everybody. Thanks for joining.
We will be taking you through today's webinar on Roth IRA conversions. If you want to ask a question during the webinar, please click on the Q&A button at the bottom of your Zoom window. We will do our best to answer questions as we go along, but we may need to save some of them until the end of the webinar, or we may need to follow up with you via email. And before we jump into the software, we'd like to give you a quick rundown on the difference between a traditional IRA and a Roth IRA, and what a Roth IRA conversion is. So, as most of you may already know, a traditional IRA is an account that is set up at a financial institution that allows an individual to save for retirement with pre-tax dollars. The funds are then able to grow tax deferred until you withdraw them in retirement. Retirement accounts that have the Roth designation, such as Roth IRAs or Roth 401ks, offer the ability to contribute after tax dollars. These contributions then grow tax-free, just like traditional IRAs and 401ks, but they offer the additional advantage of tax-free withdrawals in retirement. A Roth IRA conversion refers to transferring all or part of the balance of an existing traditional IRA account and moving it into a Roth IRA. But before implementing this strategy, there are a few things to consider. So the first one being you will owe taxes on the converted funds in the year that you make the conversion, instead of later when you make a withdrawal. So you will want to review your tax rate in that year and figure out whether a Roth IRA conversion will bump you up into a higher tax bracket. One way to avoid getting bumped into a higher tax bracket is to spread the conversion out over a few years. You'll want to have after-tax funds available to pay for the taxes for the conversion. If you choose to take money out of your IRA to pay for the taxes, then that would be considered a distribution and could result in even higher taxes paid in the year you convert. This could be worsened even more if you're younger than age 59 and a half, since you could then face a 10% federal penalty on the withdrawal. WealthTrace assumes you could or you will pay the taxes out of a taxable account if one exists in the plan. There is also a 5-year holding period on withdrawals of money that were part of a Roth conversion. If you expect that you'll need the funds within that time, you may want to consider the conversion altogether. The main benefit of doing a Roth conversion is that the funds will sit in the account and grow tax deferred over time. If you make a withdrawal immediately, then the conversion would probably not make sense, and it may put you in a worse position than if you just left the funds in your IRA. The key to getting the most of your IRA or out of your Roth, the key to getting the most out of a Roth IRA conversion is to do it when your income tax rate is low. If a person stops working before they start taking Social Security and there is no pension income, this is usually a great time for a Roth conversion because taxable income is so low compared to what it will be later in life. And that's pretty much it for the background information that we wanted to give. If anyone has any questions on this, feel free to ask those now, and we will go ahead and jump into the software. We will take a look at our example plan in WealthTrace. So we'll start over in the plan inputs and assumptions. So we have David and Jane. Both of them are 64 years old and already retired, as you can see here. And we have set their life expectancy to age 90, which we will look at a little bit more later when we run our scenarios. So let's take a look at their tax assumptions. We will be using the program estimate for the federal income tax and the capital gains tax. We have their state of residence as Connecticut, which has a progressive tax rate. When running the Roth IRA conversion in WealthTrace, the software will take this into consideration and accurately calculate the state tax rate, including those with a progressive rate. We will be running a Roth IRA conversion for David's IRA account as shown here in the qualified tax deferred section. And this account has a balance of $2 million. David also has a Roth IRA account with a balance of $250,000. You do not need to have an existing Roth IRA account in your plan when you run the conversion, but if you want to apply the conversion into the plan, which we will show you how to do later, then you'll want to create one. They have $250,000 in a joint bank account and $300,000 in a money market account. This couple have enough savings in their taxable account to pay for the Roth conversion, which is what we want since we don't want them using their traditional IRAs or existing Roth IRA to pay for the taxes. They will both start taking their Social Security benefit at age 70. David will be receiving a benefit of $45,000 and Jane will receive a benefit of $40,000. David also has a pension of $70,000 per year that he will start receiving at age 70. When they start taking their Social Security and if they have a pension are both important factors when considering a Roth IRA conversion, like we mentioned before. And to make things simple for us, we have not entered any additional cash inflows, goals and additional expenses, or other assets and liabilities. So now that we've reviewed all of our basic data input, let's head over to the Roth IRA conversion scenario. So to get here, we click on scenarios up here, and then click on the subheader called Roth IRA conversion. So we will want to convert the funds from David's traditional IRA. We only have one in the account or one in the plan. And we will start at age 65 over a 5-year period. So we start at age 65 just to give us a full year. He will be 65 in 2025. And we do the conversion over a 5-year period since he starts receiving his Social Security benefit and his pension at age 70. We will want to stay under the 24% federal tax bracket, so we choose that here. And just to give you a little bit more context as to why we're choosing these inputs, we're going to head over quickly to the cash flow projection screen, and we're going to scroll way down. So what we can see here is they have a couple of years where they have a really low marginal income tax rate. So between 2025, technically 2024 too, to 2029, they're only at 10%. And their rate jumps in 2030 to 22% because that is when they both start receiving their Social Security benefits and David starts receiving his pension. So let's head back over to scenarios again. Okay, so all three of these settings are great to play around with to determine which option is best for you. The main reason why we're doing a Roth IRA conversion for this couple is so that we can minimize their required minimum distributions later in life and reduce their overall taxes paid, along with increasing their end of plan balance. They are in that 5-year sweet spot window when they're retired, haven't started taking Social Security or pension benefits yet, so they don't have any taxable income. This gives us the chance to squeeze in a large Roth IRA conversion before it is too late. So once you've input your settings here, you can go ahead and click on the Run Roth Conversion Scenario button up here. So on this screen, you can see the base case scenario and the Roth conversion scenario. So we can immediately see that by doing a Roth conversion, they could increase their end of plan balance by over $400,000 and reduce their lifetime taxes paid by roughly $280,000. We are going to go ahead and open their conversion results in Excel just to make the data a little bit easier to view for everyone. If you want to download your Roth IRA conversion results, you can click on the format that you want to download right here and then click on the little cloud button. I have already downloaded this conversion to Excel, so I will go ahead and share that with you now. Doug, do you want to take a look at some of the Q&A questions while I pull this up?
Unfortunately, I cannot see them.
Oh, hold on.
Oh, sorry. Now I got it. Yes.
Okay, perfect.
Sorry.
Thank you.
I was in the chat.
Yeah.
Uh, okay. What's the implication of taking Social Security at age 65 versus 70? Well, lots of implications, right? Which is why you might want to switch the Social Security payment start date and amount and then rerun the scenarios. But for sure, it's going to make the Roth conversion less valuable because it's going to boost your income tax rate. So a lot of people who convert to do Roth conversion purposely delay Social Security for that reason alone, or at least it helps sway them to delay. Is the end of the plan future or current dollars? It's in current dollars, so we always strip out inflation when we show the end of plan numbers. Is IRMAA considered? Yes, definitely. We consider IRMAA. We consider changing Social Security taxation. We consider obviously federal tax rates and recently your state tax rules. So in this example, if you look at the tax rates for the state, they jump up by 1 percentage point, if I remember right, when this person turns 70. So that's another benefit of the Roth conversion. They're trying to avoid that bump up in the state tax rates as well. I'll get one more question, then we'll keep going. Is WealthTrace working on a function that would determine an optimal Roth strategy? Yes, that's always in the back of my mind to do. It's not easy, but I want to do it for sure. Sorry, one more. What about the net income, NIIT, the net investment income tax? Yes, same deal. We take it into account. It can change based on your income, and that is also taken account in the Roth conversion. So why don't you keep going, Camille, and I'll look over the questions as we go here.
Sure, thank you. So if we take a look at the Excel sheet of the data here, we can see the amounts to convert in the column up here and the years in which to do so, which is highlighted up here to the left. Down here, we can see the ending base case for the the ending balance for the base case, which is around $5.6 million. And with the Roth conversion case, this projected balance has increased to a little over $6 million. And if we scroll over, well, we don't have to scroll much, but if we look to the right, we can take a look at their projected required minimum distributions, which they will both be required to start taking at age 75. By doing the Roth IRA conversion, we can see that these amounts have been reduced drastically, almost cut in half, which greatly reduces their tax liability later in life. And if we keep scrolling a little bit to the right, we can obviously see that their federal and state income taxes, along with taxes on capital gains, will increase in the years of the conversion. But what is more interesting is to take a look at the taxes on their Social Security benefits, along with their Medicare premiums. By doing the Roth conversion, we can see that we have significantly decreased the taxes owed on their future Social Security payments or payments, and we have greatly reduced their Medicare premiums. It is worth pointing out, however, that the Medicare premiums will increase during the years of the conversion, which is highlighted here, but the long-term benefit still outweighs the years of the higher premiums during the conversion. If we scroll all the way to the right down here, we can see that the total estimated taxes paid over their entire plan in the base case scenario was around $1.45 million. And after the Roth conversion scenario, this has been reduced to around $1.15 million, a difference of $280,000 paid over the lifetime of their plan. I'm going to head back over to the software if you want to look at some more of those questions, Doug.
Oh, yeah, I've been answering some through chat.
Oh, perfect.
Um,
So I'll let you look at those a little bit and we'll head back over to some of our underlying assumptions because we're going to run one more scenario. So another scenario that we can run is what happens if one person lives much longer than the other one. So if we head back over to the personal settings page or personal information page where I'm at right now, we're going to change Jane's life expectancy to 100. So she's going to live a long time. And then we're going to head back over to the scenarios tab and we're going to rerun the Roth IRA conversion scenario and see what happens. So all of the underlying settings for the conversion are going to be the same. So we are still starting at age 65. We are converting over 5 years. We're staying under that 24% federal tax bracket. I'll go ahead and run that. Since we have increased Jane's life expectancy to 100, we can expect the ending investment balance for the base case to be less. In our original case, this projected ending balance was around $5.6 million, and in this scenario, it's around $5.4 million, which makes sense. What is more interesting, however, is that the projected ending balance for the Roth conversion scenario has increased from roughly $6 million in our previous scenario to $7.45 million in this one. The taxes paid over the life of their plan have also been reduced by close to $1 million. So I'm going to go ahead and pull up the Excel sheet for this scenario as well. So give me one moment. Okay. All right, so as we can see up here to the left, the years and amounts to convert are the same as in our original scenario. We haven't changed anything there. And the red line that you can see here is just to mark the point when David passes away so that we can see what happens to the taxes when Jane is left on her own. When one spouse passes away before another, it can make a huge impact on the remaining spouse. When one dies, the other one immediately gets bumped into a higher tax bracket since they now have to file as a single taxpayer. This is something that is very often overlooked in retirement planning.
yeah, I want to jump in because I've been hammering this point for years now, and for some reason the mainstream financial media doesn't even talk about it. Uh, the life expectancy in general with retirement planning has a big impact, but it can have an impact in several ways. And one is does a Roth conversion make more sense if someone passes away earlier than the other spouse or partner? The answer is almost always yes, it makes a Roth conversion more valuable. And that doesn't even get into the jump in tax rates if one person dies earlier. It's pretty harsh, and it's wise to run a plan a few different ways with different life expectancies just to see if it still holds up like you think it should. You know, whether it's Monte Carlo or whatever numbers you like to look at, because the jump in tax rates is severe. So this is really important with Roth conversions, not only the tax jump, but also how long you set the life expectancy for, because Roth conversions really have a big time component to them. You want them to grow tax deferred as long as possible. The longer they get to grow tax deferred, the more valuable it is. And so if you assume life expectancy of 80 versus 90, it's going to have a big impact on whether the Roth conversion makes sense.
Mm-hmm. Yep.
And
So we can
sorry, one
see.
more thing. I keep
Yep.
getting a lot of questions about the IRMAA and Medicare payments. I might have missed it. Did you show where people can view the Medicare premiums
Yes.
base case versus scenario.
Yep. So you can view
Okay.
those right here.
Yeah, so that's where we show the impact of IRMAA for all the people that are asking.
It's not highlighted in this one, but it's right here. So we can see over here to the right or here in the middle that her marginal federal tax bracket is 35% when she is on her own. Unfortunately, the Roth conversion did not really help bring her tax rate down when David passes, but we can look at her RMDs, for example, and see that those have still been reduced drastically, which means that she will have less income to be taxed on. And we recently wrote a blog post about the impact of one spouse passing away earlier, where we talk about strategies and how you can prepare. So we highly recommend that you take a look at that as well if you haven't already. And that's really it that we wanted to touch on with this one, so it's not super repetitive. So we're going to head back over to the software again, and we're going to look at another scenario that you can also run. So another good scenario to run is one where you change the underlying tax settings. So if we head back over to plan settings and assumptions, we're going to go ahead and change her back to 90. We're not running the other scenario. We're just going to talk about it, but it's good to get our settings back to normal anyway. So now that we are in the taxes setting, we're going to change the setting here that says use federal income tax brackets and rates prior to 2018 changes. And just to provide some context here, this setting refers to the Tax Cuts and Jobs Act, which is difficult to say quickly, that went into effect in 2018. And in short, this law reduced the rate of some of the individual income tax brackets, among many other changes. The Tax Cuts and Jobs Act is set to expire in 2025, meaning the individual income tax brackets will go back up to the previous rates. If you toggle this to yes, you can rerun the Roth conversion scenario to see how that affects your results. Many people believe that the tax rate will go up even further in the future due to multiple reasons. One of those reasons being the US national debt. The national debt is surging and is expected to grow even larger as Congress is spending way more than it is collecting. Most revenue collected by the federal government comes from the individual income tax. Therefore, the solution is either to collect more taxes or reduce government spending. Many experts believe that collecting more taxes is the most likely outcome. So one great way to prepare for these potential tax increases is investing in a Roth IRA or, like we're talking about today, doing a Roth IRA conversion.
We have a
So,
good question I wanted to hit on
yeah.
that I didn't think about
Mhm.
bringing up. We should certainly have a knowledge-based article on this. I don't know if we do. What are the return assumptions when we do the Roth conversion? Does it use the asset allocation in the existing Roth? This is a good question. We do not. We use the allocation and return assumption from the IRA or 401k that it's coming from. That way
Mhm.
we can compare apples to apples in the tax results and the overall end of plan value results. So we assume that the allocation it's coming from, it's going to go to the exact same allocation in the Roth. That way, otherwise the return assumptions can be different and completely muddle the answer.
Mm-hmm. That's a good question. So let's run through how to implement the Roth IRA conversion in the plan, and then we can go through a couple more questions. So if we head back to the investment assets section, you can manually create a Roth IRA account by simply clicking on the Add Investment Asset manually. If you don't already have a Roth IRA in your plan, we have one here for David. So we're going to go ahead and click on the pencil icon and to edit the account, and then we will click on Annual Contribution. So towards the bottom here, you can see, or you can indicate whether or not there will be any conversions from a traditional IRA to this Roth IRA, and we will select yes. The first step is to select which IRA you will be converting from. We only have one traditional IRA in this plan, which is the IRA for David. So we have that selected already. And instead of selecting to convert a percent of the account, we're going to select to enter dollar amounts, which you can do right here. And then you click on this button, and in here you can indicate, um, sorry, you can indicate, you can add a row and indicate how much you will be converting and for how many years. The easiest option to plug these numbers in is to run the Roth IRA conversion first and download it to PDF or Excel. And you can then pull up your results and have it either side by side on your computer or on another screen, or you can even print it. And that way you can easily enter those numbers here. And I also want to mention in our new user interface that we will be releasing in a few months, you will have the option to auto apply your Roth IRA conversion. So that way you won't have to pop into this section and manually enter the amounts. That's pretty much it for the content of the Roth IRA webinar. Do you want to run through some of the questions, Doug?
Yes, just look at a few of them, and everyone can keep typing in if you want. This is more of a subjective thing, but it's worth bringing up. What is your recommendation if the ending balance is lower by doing a Roth conversion, even though you might save more taxes? Well, I think that you can obviously save more taxes and still be worse off over time due to the timing and compounding effects, right? So I myself like to look at the end of balances in terms of making the decision. But there are some subjective things. Let's say it's nearly a tie in the scenario versus the base case. There are other things to take into account, such as number one, you could be hedging against future tax increases, which Camille talked about a bit. You could also, and this could push you one way or the other, be thinking about your heirs to the money. The Roth IRA would be tax-free for your heirs. The IRA, traditional IRA, would not be. They would have RMDs on it. So a lot of people, if it's even close, they're like, well, of course I'll convert because I want to leave my money tax-free to my kids, or whoever it might be. So there are some semi-subjective things there to think about. Keep looking.
So Joe is asking if there are any exceptions to the 5-year holding period on converting or converted funds. Are you aware of any exceptions?
I'm sure there's one in there that I can't remember right now. Some emergency type of,
Yeah.
the law is so convoluted now with these things that I've honestly, I can't say with 100% certainty. I'd have to research it.
I did a quick research and it looks like you can use a portion of it to pay for your first home, similar to your IRA withdrawals that you can make earlier, or you can use some of the money to pay for higher education for yourself or a spouse, child, or grandchild. So a Google search would help you there. And the penalty, if you do withdraw it not for a qualifying reason, is 10%.
Okay. I've gotten a couple of questions about the timing of the conversion and if it's by month or how we do it. We assume end of the year. That's it. We try to keep it somewhat simple in that way. So yeah, the Roth conversions are end of year. What happens if you enter more conversion dollars than are available? You can't do that in the scenarios, but if you did that in the actual plan, then it would just eventually the money would run out in the IRA and it would just stop there. So you basically can't do it. The software won't let you. Return assumptions. Would it make more sense to allocate towards growth since it's for the long term rather than whatever the IRA is in? Sure, I suppose I mean, this is more advice, so I can't say, but if you wanted to think about it that way, I would switch the IRA to growth because you, again, otherwise you're not going to be able to make a fair comparison. You don't want to compare apples to oranges. So I would switch the traditional IRA to more growth, and that way you can compare apples to apples on that one. Is the break-even age of the portfolio balance a consideration? Absolutely. If the break-even age is 110, where you break even with the Roth conversion versus not doing the conversion, well, maybe you want to think twice about it. If the break-even age is 80 or younger, well, you're more likely to hit it, right? So I would say yes, definitely.
We had someone ask if we could run through the highlighted columns in the table a little bit more and explain what they mean. I'm going to leave it up here just so everyone can read through it. There isn't too much that I didn't really touch on. It's just if you look at the columns, you'll see, obviously you'll see one for base case, one for Roth, and the difference. So it may look like there's a ton in here, but if I can scroll through here, if anyone wants to look at it, so I'll leave it up here. And if there's a specific question, let us know.
Okay, I'm just looking through a few more here. How do Roth conversions affect your average capital gains tax rate? Oh, it can definitely bump your capital gains tax rate up when you do the Roth conversion, right? And then later on, it could be lower, and that includes the net investment income tax that gets added to the capital gains tax rate. So it's all taken into account. That's the beauty of getting just a couple numbers to look at. You know that all the timing of everything, compounding, tax rates, all the various tax rates, they're all changing appropriately based on your income in every year. Will the scenario help you understand tax liability? Definitely. It's all, or a lot of it is there. Where Camille is right now, you can see the various tax rates and I think total taxes paid is in there.
Yes.
So
So it's per year, but I calculated the total, so it's down here.
I
Normally,
mean,
down
sorry,
here.
total taxes paid by year. Yeah, that's what's
Yeah. Yep.
yeah, there you go.
So obviously it's high during the years of the conversion, which we can see right here.
Can you show real quickly, Camille, one more time where you enter the Roth conversions into the actual plan?
Yeah. Yep. Let me screen share that real quickly. So you will want to pick your Roth IRA, click on the pencil icon, which allows you to edit the account, and then click on annual contributions. And then down here, you click yes, that there will be conversions. Pick what account you're converting from, enter dollar amounts, and then click on the button to enter the amounts per year. You can scroll down to add more rows. Can leave this up here a little bit.
I've had several questions about combining accounts. You don't want to run or should they be run separately? Running them separately will not help you. You have to run them combined, um, unless you're going to do them over different years. But I don't think that's what most people are looking for. So we will have a way to just pick and choose multiple accounts at one time. That's coming soon. For now, there's a knowledge base article on running multiple Roth conversions at one time. You basically have to add them together and then run it. So for now, that's what you need to do.
If you head over to the knowledge base, I can show this too, so that you all know what to look for. So if you're
Oh
in the
yeah.
knowledge base and you just type in multiple Roth, for example, and hit enter, you can see this first article. And then down here, it explains. Actually, no, this is not the good one. Hold on. There we go. So this is the one that you can take a look at, and it'll show you how to do that. Basically, you just combine multiple accounts into one account temporarily, and then you can run the conversion on that one account instead. Can leave this up here too. Oops, sorry, my browser wants to jump around a little bit. David is asking a little bit about the updates for the new user interface. Do you want to talk about some of the biggest changes,
Uh,
enhancements?
yeah, I mean that we're hoping 4 months away, and I
Mm-hmm.
did send out an email about beta testing, needing
Mm-hmm.
beta testers. It's mostly speed and look and feel and layout. There's not going to be a ton of new features per se in it. It's really just an overhaul of the graphs, the overall look and feel, the ease of use, and the speed. And that will become very apparent if you're a beta tester or when we actually release it.
Mm-hmm.
We do have a question I never really thought about answering or putting in the knowledge base. It's a good question. Can you tell which savings account or account to take the money out of to pay the taxes on the Roth conversion? Well, it works the same way as all of your expenses. If you're withdrawing in order, which most people do, it will literally go in the order in which they are located in the taxable section. And you can drag and drop those to change the order. So it's just going to go in order, just like it will for any of your expenses. Someone says you seem to recommend never doing a conversion if taxes are paid from the IRA itself. I don't know if anybody said never, but it certainly harms the conversion
Mm-hmm.
value. And to be honest, I run a lot of scenarios in these things, and I was surprised how much it hurts it. It's really surprising how much it lowers the value of the Roth conversion if you have to pay taxes out of the IRA itself, because then you're taxed again on that amount, and it doesn't get to grow tax deferred in the Roth. So I would definitely not say never, but it is surprising how much it reduces the value.
Mm-hmm.
Um, Instead of converting the entire traditional IRAs, is there a way to set a dollar or percentage amount instead of the entire value? Well, we weren't converting the entire value necessarily. It was just the amount such that you stay under a certain tax bracket. I doubt it converted the entire thing. So that's one
No.
thing. And number two, there is a way to tell the program, it's an option to say, I want to convert 40% of the IRA over this many years. So you definitely don't have to convert the whole thing. Yeah, there's a manual entry, which is uh, can be valuable just to see, just to play around and see if you can maybe come up with a slightly better scenario. It usually doesn't happen. Usually it's better to stay under a certain tax bracket.
Mm-hmm. We have someone asking if unused, I'm assuming he means 529 funds can be converted to a Roth. And we are just in the process of finishing up a blog post about this. So if you guys take a look at our blog page, you will find out more about how that works.
Oh yeah, that's timely.
Yeah.
The answer is supposedly you're supposed to be able to do it.
Yeah.
But there are a lot of vague rules with it. So, but yeah, we have a blog post coming out very soon.
Very vague.
Uh, if accounts are linked, do you need to manually make the Roth conversion change in the plan, or will the program pick up the change? Oh, if the conversion actually took place in the real world, then it should update the next day if the accounts are linked. So you'll see the balances change. That's a good question. Yeah. So that's the beauty of linking, right? All these things just you'll wake up the next morning, log in, and there it is.
Hmm.
Okay. Uh, I think the rest of these need a little follow-up.
Mm-hmm.
Not sure I see anything else that's I want to get into here. Yeah.
Yeah, we can follow up on the rest of those questions via email as well.
Yeah, I think I need more information on some of these, or I should say on really all of them that I'm looking at. Unless there are any last second questions from anybody.
While people are thinking about that, let me also quickly mention our various options for customer support. So we have a live chat, which you can see down here to the right if you just click on this little window. If there are no live agents, then you can leave us a message and we will get back to you as soon as possible. We also have an extensive knowledge base, which we just looked at, where you can find answers to our most frequently asked questions. You can type any questions that you have in the search bar, and any related articles to that question will pop up. And I also want to mention that we offer expert support sessions with you, Doug, um, where he can audit your plan for you and review all of your inputs with you. And if you have any other questions, except right now the webinar, feel free to send them through the live chat to us, or you can also email us at support@mywealthtrace.com, and we will be happy to answer any questions that you have.
Yeah, and speaking of the expert sessions with me,
Mhm.
there's a question just came through that would be perfect for that kind of session, which is question is, what's your thought of paying Roth conversion taxes from the income generated from the already converted Roth?
Hmm.
Well,
Interesting.
that you can do it in the plan. You can run that scenario. I would say it's probably not the best idea, but you never know. It's plan by plan, and that's the kind of thing that I dig into in the expert support sessions, amongst other things, right? I make sure that you just haven't made any major mistakes in your plan in general, but we can really dig into Roth conversion scenarios and other scenarios too.
Hmm. Also seeing a question about the state tax rate. And yes, we do now support the progressive tax rate. So instead of entering a static rate, you can enter whatever your state is, and that will be taken into consideration in the Roth conversion as well.
Yeah, if you have not switched that over yet in your plan, please think about doing that,
Hmm.
because that way, because we keep up obviously with all these tax rules, we'll do it for you, and obviously it's more accurate anyway because most states have some sort of stepped up progressive tax system. So the average is just an estimate. Why not let the program calculate it for you?
Hmm. Yeah, so that's pretty much it. If anyone has any other questions, feel free to shoot us an email. We will follow up with all of the unanswered questions from the Q&A as well via email, so you will hear from us. If you don't hear from us today, probably tomorrow, but we'll try and get those out as soon as possible. We'll also have the recording of the webinar available if anyone wants to rewatch it or send it to someone else. We will email that out as soon as that is ready as well. But that is it. And thank you to everyone that attended. And yeah, that's it. Do you have anything else to say, Doug?
Nope. Thanks, everybody. These webinars, we appreciate everyone being so interested and all these good questions. It helps make the software better, and
Mhm.
we're going to keep doing it. So we'll see you guys next time.
All right. Thank you so much. And I hope everyone has a great day.
Take care. Bye bye.
Bye.